In 1929, as Wall Street screamed and fortunes evaporated into thin air, one man calmly watched the chaos unfold. He wasn't a victim, he was the architect. While the world plunged into the Great Depression, Jesse Livermore made a cool $100 million, an amount so vast it's like making $1.6 billion today. For a moment, he was one of the richest men on earth. But this story doesn't start in the boardrooms at New York. It starts with a 4-year-old boy, a runaway with just $5 in his pocket, a gift from his mother, who blessed his escape from a future of back-breaking farm labor. Before he was even a man, he had gamed a system designed for suckers, turning that pocket money into his first $1,000. This is the story of Jesse Livermore, the original boy plunger, a Wall Street legend so good at winning, they eventually banned him from trading. It's a story of genius, ruin, and the timeless battle a trader fights not against the market, but against himself. Jesse Livermore was born in 1877 in rural Massachusetts into a life he was desperate to escape. His father, a farmer, saw Jesse's future in the soil, yanking him out of school at 14 to work the land. But Jesse's mind didn't run on the rhythm of the seasons. It ran on numbers. He was a prodigy who reportedly blazed through 3 years of math in a single school year. His mother saw his gift and, in a secret act of defiance, helped him run away from home, pressing $5 into his hand. He landed in Boston and, by a stroke of luck, found a job that would change the course of financial history. He became a board boy at the Payne Weber stock brokerage, chalking up stock quotes on a giant board, day after day, watching the numbers dance. A ticker tape machine would clatter out the latest prices, and someone would call them out for Jesse to write. For most, it was just noise. For Livermore, it was a language. He wasn't just posting numbers, he was absorbing them, seeing something no one else did, patterns. In a little notebook, he began meticulously recording these price movements, not just the prices, but the way they moved. He saw rhythms, repetitions, predictable behaviors. This wasn't about the companies or their earnings, info that was scarce and unreliable anyway. This was about the raw data of the market itself, what we now call technical analysis. Livermore was pioneering in his head as a teenager. He soon realized his predictions, tested in his notebook, were startlingly accurate. A friend convinced him to put real money on the line. But at 15, he couldn't open a real brokerage account. So, he walked into the financial world's seedy underbelly, the bucket shops. Bucket shops were basically gambling dens masquerading as brokerages. You'd find them in cafes, back rooms, and drugstores. When you traded there, you weren't actually buying stock. You were just betting against the house on whether a price would go up or down. The shop took the other side of your bet. And since most amateurs lose, the business was incredibly profitable. For the average Joe, it was a quick way to lose his shirt. For Jesse Livermore, it was a perfect laboratory. His system of reading the tape and spotting patterns was made for this world. His very first trade on the Chicago, Burlington, and Quincy Railroad netted him a small but thrilling profit of $3.12. He was hooked. He started sneaking out on his lunch breaks to place bets. Soon, his winnings dwarfed his weekly salary. At 16, he quit his board boy job to trade full-time, and by the time he was a man, he had turned his initial stake into $1,000, an incredible sum for the time. But the house doesn't like to lose. Bucket shop owners quickly identified this quiet teenager as a major threat. They nicknamed him the boy plunger, a plunger being a reckless speculator. Soon, they'd refuse his money the second he walked in. He was blacklisted. Livermore had to resort to disguises and fake names just to place a trade. Eventually, every bucket shop in Boston knew his face. He moved to New York around age 23, only to find his reputation had preceded him. By the time he was in his early 20s, he'd amassed a small fortune of around $10,000. But his days of gaming the bucket shops were over. He had outgrown the minor leagues. It was time to take on Wall Street. In his early 20s, Jesse Livermore arrived in New York City with about $10,000 and his system honed in bucket shops. He was ready for the big leagues, the New York Stock Exchange. But the transition was brutal. The very skills that made him a king in the bucket shops were useless here. In a bucket shop, a trade was instant. On the real exchange, there was a delay. An order had to be set to the trading floor, and by the time it was executed, the price could have changed. This ticker tape delay wrecked his strategy of jumping on tiny, rapid price moves. In May 1901, he went all in, shorting the market. But the tape was too slow for him to react, and he lost everything. He was wiped out. Broken, humbled, Livermore had to adapt. He borrowed some money and went back to the bucket shops, this time in St. Louis, where he wasn't known to rebuild. But he knew this was temporary. He had to learn the new game. He realized he could no longer be a scalper. He had to trade for the big swing, holding positions for days or weeks. This shift from pure tape reader to a big picture speculator was the most important of his career. His first monumental win came in 1901. At 24, he bought stock in the Northern Pacific Railway and, in a spectacular trade, turned $10,000 into $500,000. He was back. In 1906, while on vacation, he got a powerful gut feeling that Union Pacific Railroad stock was about to fall, even though it was trading strong. Acting on a tip from the speculator Thomas W. Lawson, he took a massive short position right before the devastating San Francisco earthquake. As the city crumbled, so did the market, and Livermore walked away with a $250,000 profit. This trade cemented his reputation. He wasn't just gambling. He was anticipating seismic shifts in the market, literally. The event that made him a legend, the Great Bear of Wall Street, was the panic of 1907. As the market showed signs of weakness, Livermore started aggressively short selling. When the Knickerbocker Trust Company collapsed, panic erupted. Banks failed, credit froze, and the market went into a free fall. As chaos gripped Wall Street, Livermore was methodically closing his short positions. In a single day, he made over $1 million. His net worth soared to $3 million. He was shorting the market with so much force that the legendary banker J.P. Morgan, who was trying to bail out the entire financial system, sent a messenger to find Livermore. The message was a plea for the good of the country. Would he please stop? At just 30 years old, Livermore was so powerful, the most influential financier in the world had to ask him to stand down. He agreed, and then in a final stroke of genius, he started buying, profiting from the rebound he knew Morgan's intervention would create. Jesse Livermore wasn't a gambler. He was a speculator with a strict set of rules, forged in the fire of his own wins and losses. His insights, captured in the classic book Reminiscences of a Stock Operator, became the Bible for generations of traders. His first rule was about survival. He famously learned that the key to staying in the game wasn't just making money, but avoiding wipeouts. This led to his most famous mantra, cut your losses quickly. He believed the loss should never be allowed to grow. If a trade went against him by 10%, he sold. No questions asked. He argued that most speculators are defeated by hope, hoping a losing trade will magically turn around. Livermore replaced hope with a healthy dose of fear that a small loss could become a catastrophic one. The flip side was just as important, that your winners run. He knew the real money didn't come from a bunch of small wins, but from riding a few powerful trends. It was never my thinking that made the big money for me, he said. It was always my sitting. The average trader gets scared and sells too early, afraid of a profit slipping away. Livermore trained himself to be patient and hold on as long as the trend was his friend. His entire system was built on finding the line of least resistance. He believed prices, like water, will always follow the easiest path. If it's easier for prices to go up, the trend is up. If it's easier for them to fall, the trend is down. His job wasn't to predict the future, but to identify the present trend and ride it. Markets are never wrong, he'd say. Opinions often are. To time his entries, he used what he called pivotal points. A pivotal point is a key price level, like a breakout to a new high. When a stock blew past a pivotal point on high volume, it was his signal that a major move was underway. He wouldn't just jump in. He'd first probe with a small position. If it immediately showed a profit, he knew his judgment was right. Then he would add to his position as the trend continued, a strategy called pyramiding. He was adding money to a trade that was working, not one that was failing. Finally, Livermore learned he had to master his own emotions. The human side of every person is the greatest enemy of the average investor or speculator, he stated. He knew fear and greed destroyed accounts. His own devastating losses almost always came when he broke his own rules, when he listened to a hot tip, got impatient, or let pride stop him from cutting a loss. Success wasn't about being the smartest person in the room. It was about being the most disciplined. In the end, you aren't trading the market, you're trading yourself.
Look at these veins, we're rich.
The Roaring Twenties were a decade-long party on Wall Street. The market soared, and speculation fever gripped the nation. But Jesse Livermore, the Great Bear, saw a bubble. He saw the classic signs of a market divorced from reality, fueled by borrowed money and blind hope. While others celebrated, Livermore got to work. He felt the market was on its last legs, and the line of least resistance was about to shift downward. As early as 1928, he began placing small, short positions. The market kept roaring higher, and by the spring of 1929, he was reportedly down over $6 million on paper. An ordinary person would have panicked, but Livermore trusted his analysis. He was waiting for the tape to confirm what he already knew was coming. To pull off his grand plan, he operated in total secrecy from a fortress-like penthouse office on Fifth Avenue. Once the market opened, no one in the office was allowed to speak. He used over 100 different brokers to hide the massive scale of the short positions he was building. It was a spider web of accounts designed to mask his presence as he built a bearish battleship right under the nose of a euphoric bull market. The crash began on Black Thursday, October 24, 1929. Panic selling erupted. Powerful bankers stepped in to prop up the market, causing a temporary rally. It shook out a lot of the bears, but not Livermore. Then came Black Tuesday, October 29th. The floor of the New York Stock Exchange descended into pure chaos. A tidal wave of sell orders hit, but there were no buyers. The ticker tape ran hours behind, unable to keep up with the collapse. Fortunes were wiped out in minutes. While the world was ending, Jesse Livermore sat in his quiet office watching the numbers. His wife Dorothy was terrified, convinced he was ruined. When he finally came home that evening, she reportedly asked him, "Is it bad?" and told her it was the best trading day of his life. He had netted approximately $100 million. In today's money, that's a profit of around $1.6 billion made in just a matter of days. The boy plunger was now the Great Bear of Wall Street. At his absolute peak, Jesse Livermore stood as the undisputed king of the market. The triumph of 1929 should have secured Livermore's legacy forever. Instead, it was the beginning of his tragic final act. The man who had mastered the market was about to be destroyed by the one opponent he could never beat, himself. After the crash, he lived an impossibly lavish life with a mansion, a 300-foot yacht, and private rail cars. But the money seemed cursed. He began to break the very rules that had made him a legend. The discipline that defined his greatest trades vanished, replaced by ego and emotion. A big blow came in 1934 with the creation of the Securities and Exchange Commission. The new regulations banned many of the speculative tricks Livermore had perfected. The game had changed and he couldn't adapt. His attempts to corner markets failed, leading to massive losses. His personal life was just as volatile. His marriage to his second wife, Dorothy, fell apart amidst her heavy drinking. In 1935, during a drunken argument, Dorothy shot their son, Jesse Jr. He survived, but the scandal pushed Livermore deeper into despair. He divorced and remarried. Financially, he was bleeding out. By 1934, just 5 years after his $100 million score, Jesse Livermore declared bankruptcy for the third time in his life, listing assets of just $84,000 against debts of nearly $2.5 million. He was broke and suspended from trading on the Chicago Board of Trade. The legend had completely unraveled. Haunted by his failures and plagued by depression, he published a book, How to Trade in Stocks. In 1940, a last attempt to share the wisdom of a lifetime. On November 28, 1940, at the age of 63, Jesse Livermore walked into the cloakroom of a Manhattan hotel, sat down, and took his own life. Police found an 8-page suicide note addressed to his wife in his notebook. His spectacular life story of rags to riches was over. The story of Jesse Livermore is more than a financial biography. It's a timeless cautionary tale. It proves that a fortune can be made by understanding the market's patterns, but it can only be kept by understanding your own. He was a pioneer, a genius who saw the future in numbers, but his legacy is a stark reminder that in the great game of Wall Street, the most dangerous enemy you'll ever face is the one staring back at you in the mirror. In conclusion, Jesse Livermore's story shows that market genius isn't enough. Psychological mastery is the real key. What do you think is the single most important rule for a trader to follow to avoid a similar fate? Let me know your thoughts in the comments below.